This is part 2 of our chapter 2 video lecture where we're going to get an overview of a topic called tax credits. So as a review, if you remember how we went through the simplified formula calculating our tax all the way down here by multiplying our taxable income, that's line 11B from the 1040 form, and we use either the tax table or the tax rate schedule to calculate out the total tax liability for the year. But our tax system doesn't allow you to pay this big, large tax liability when you file your return. You should be paying taxes throughout the year. So we have to reduce this liability by the taxes you already paid. Sometimes we call that prepaid taxes. Maybe this is the withholding your employer takes out of your paycheck. Or if you're self-employed, or if you have investment income, maybe you have to pay taxes on your own called estimated taxes. So we'll talk about those payments possibly in our last video for chapter 2. But to help you reduce your tax liability for the year, we're going to subtract out an allowance the government gives you called tax credits. So they're just as good possibly as taxes you already paid because it's going to reduce your tax bill. So you can see things we're subtracting down here. Let's put down here either tax refund, or maybe if you still owe money, a balance due. A balance due. So way up here, remember how we subtracted out deductions to reduce the taxable income? And now we're going to be subtracting out tax credits to reduce our balance due or possibly increase the refund that we're getting back. Now, if you have $1 of deduction, it's not going to save you $1 of taxes here, the tax liability. But if you have $1 of tax credit, the topic we're talking about now in this video, it is going to save you $1 of taxes here. $1 of deduction is going to save you whatever percent bracket you're in as your so-called marginal rate. So if you're right now in the 22% marginal rate, $1 of deduction is going to save you 22 cents. But $1 of credit is going to save you $1 of tax liability. So dollar for dollar, a tax credit is worth more. A tax credit is worth more than a dollar of tax deduction. Now, to make things more complicated, we're going to have two different categories of tax credits. One type is called non-refundable. Sorry for my bad handwriting. And the other type is called refundable. So of the two types, the refundable type is preferred. The non-refundable type, you can only use up to the amount of tax liability you have. So if your tax liability is already zero because you have lots of deductions above in that formula, you cannot use any of the non-refundable credits. But if you have refundable credits, they're treated like taxes you've already paid, and that's going to give you back a bigger refund. Again, non-refundable tax credits can only be used to the extent of the tax liability. If you have more non-refundable credits than a tax liability, either those non-refundable credits are going to go wasted, or some credits may be able to be carried back or carried forward to a future year. Okay, but you cannot use it this year. As compared to the refundable type credits, it'll help you get back a bigger refund. So let's take a look at how it's showing up on the tax forms. So if you remember on our 1040 form, we calculated already down to this taxable liability here. So here you can see there's a tax credit called child tax credit and other dependent credit that we'll talk about in another video. Most of the credits are first reported here on a Schedule 3. And then there's some more credits down here. Earned income credit, additional child tax credit, American Opportunity Credit. You notice all these credits way down here are right next to the income taxes that you've already paid through withholdings. So these are the refundable type here. They can make your refund bigger. But the credits up here can only be used to the extent up to the tax liability here in line 12B or 12A. So let's take a look at this Schedule 3. I've already downloaded it here on my browser. Schedule 3 that has credits and additional taxes already paid by the taxpayer. The non-refundable type are appearing grouped in Part 1, and the refundable type credits are grouped in Part 2. So the first one mentioned in our textbook is called foreign income tax credit. In other words, you have income that you've earned in a foreign country, and that foreign country taxed that income. You've already paid taxes there. And now because you're a U.S. citizen or a U.S. resident, that same income has to be reported on your 1040 form, and you got to pay taxes again. So that's double taxation. The general rule is if you get taxed by two different countries, the country where you're a citizen or resident is going to give you a credit to reduce the amount of tax liability, or for example, maybe you have income earned in a different state here in the U.S., but you're a resident in another state. So you're going to be taxed twice again. The state or the country where you're a resident generally will give you a tax break by giving you a credit. Here we're told we need to fill out this form 1116. Now, our textbook just only goes briefly through this topic of foreign tax credit. For most taxpayers, they may have paid foreign taxes because they have an investment, maybe they're receiving dividends in a foreign stock, or they have a foreign bank account and they're collecting interest income, and the foreign tax is being collected in that foreign country. And now again, you're reporting that same income, possibly because you receive a tax form like a 1099 form, and it shows the foreign taxes withheld. Let's see if I can bring up a foreign form here. So I'm going to go to Google here, and if I type in IRS, the year 2019 form 1099 DIV. This is possibly a fast way if you don't have the link already. So typically the first one here under IRS site where it says PDF, it'll show you the tax form. So maybe you'll get one of these 1099 forms showing the dividend income that will be over here in one of these two boxes, and also the foreign taxes that may have already been paid. And you can use this as a foreign tax credit. Now you don't have to fill out possibly that form 1116 if the total foreign tax credit you're going to claim is less than $300 or less than $600 if you're filing a married filing joint return. And the foreign income that's being taxed is typically just interest, dividends, some type of investment, and not so-called work income, earned income like a job or salary or business income. We'll learn about something called a foreign earned income exclusion maybe in chapter 4. Yeah, but we're talking about investment income, some type of foreign investment. And all you need to do is possibly write in that $300 or $600 max amount over here and not file this form 1116. And here's some other non-refundable credits we'll get into in some more videos. You take a subtotal here in line 7, then you rewrite it back in your 1040 form here in line 13B, and you get to subtract it out here to the extent of any tax up here. Remember, you cannot use more credit here than the tax because this is a non-refundable type. It cannot make your refund down here bigger. It only can bring it down to a tax of 0 due, yeah? Versus the refundable credits here. Okay, so continue into the next video and we'll talk about another credit. I believe we'll talk about this second credit here, number 2, called the child and dependent care credit.